All right, so let me continue here. Guys, I know I'm a good teacher, but there's got to be one question at least. Something, throw me a bone, whatever it is. I got to work for the money. All right, going once, going twice, going 3 times. All right, we're continuing. So it says prepayment privilege. The loan may be paid off early without penalty. And we were talking about FHA loans and VA loans. No, I think I covered this, right? No, I didn't. I guess I'm repeating myself. Oh yeah, because we did talk about it in the conventional loan. So assumability, VA loans are assumable with lender approval. Usually the person assuming the loan must have a VA eligibility and the assumption may have to be approved by the VA. Interest rate. Lender and borrower negotiate the interest rate for all the insured loans. So let me ask you this. What's the difference between a fixed, an interest rate and an APR? What is the difference between the two? Let's see if you guys remember. This APR was in chapter 13. So Charlie says, Chile or Charlie? Okay, no problem, Zoraida. All right. So annual percentage rate can change, right? So a loan can give you an interest rate, right? You have 3 banks, Bank of America, you have PNC Bank, and these are just for the example because lenders use other banks, and you have Valley Bank. Okay, and they all say 3%, right? They all start at 3%. So what happens here? Okay, now that's the rate, the ongoing rate for the loan. But once you have the APR, is the annual percentage rate, you get to include the fees. So each bank might have a different fees that they charge. This one could be 3% 250. This one could be 3% 025, right? This one could be 0.678 or something like that. That's the APR. So when you have a loan, you have the closing disclosure, okay? After the loan has been originated with all the fees, how much you have to pay, what your loan is, and your monthly payment and your down payments and your closing costs. At the end, it will have, in the beginning, it will say 3%, but at the end of the CD, it will have the APR. You could have a 3.5% as your interest rate, but your APR could be 4.678 or something like that. So it's very, very different than what you start off with because of the fees. Okay, so we also have point fees and costs associated with VA. The lender may charge discount points, origination fees, and other reasonable costs such as VA property appraisal, the credit report, and state and local taxes. And recording fees may be paid by the veteran purchaser, the seller, or shared both, but may not be financed. The VA funding fee, however, may be included in the loan amount. The funding fee is a percentage of the loan amount, which varies based on the type of loan, military category, whether the loan is a first-time loan, and whether the loan is a down payment. The seller is allowed to pay for some closing costs up to 4% of the loan amount, including prepaid closing costs, the VA funding fee, pay off credit balances or judgments for the veteran, and temporary interest buy downs. No commission, brokerage fees, or buyer broker fees may be charged to the veteran buyer. Other veteran programs. In addition to insuring loans to veterans, the VA may insure loans for lenders who set up a special account with the VA. The VA may also actually lend money directly when an eligible veteran cannot find other mortgage money locally. Other financing techniques. Oh, Shayla. That's how you pronounce the name, Shayla? If I can get a nod, because the people look really small. No, that's not it? All right, let me unmute you. Okay, how does it sound?
It's Chalet.
Oh, Chalet. Sorry.
Yeah, you said it right the first time when you first said
Oh,
it.
I did? Okay, I'm
Yeah,
sorry.
you did.
I'm sorry. I'm bad with names. That's
No, it's okay.
I'm notorious for that. Okay, I'm so sorry. I try my best. But thank you. Okay, so let me continue here. I'm sorry if I butchered your name. I'm totally sorry. A package loan. Okay, other financing techniques. Since borrowers frequently have diverse needs, a number of financing strategies that apply to various property kinds have been developed. The owner finance transaction that can be secured by a purchase money mortgage has already been described. There are also numerous ways to structure money in various circumstances. A package loan consists of both real and personal property. So these are other techniques of financing. In recent years, developers and purchasers of unfurnished condominiums have found these loans to be extremely popular. Typically, package loans include furniture, curtains, the kitchen range, microwave oven, refrigerator, dishwasher, washer and dryer as part of the home sales price. A blanket loan. You might see a question on the state exam. Another question on the state exam applies to multiple parcels of lots. It is typically used to finance a subdivision by a developer, but it can also be used to finance the purchase of improved properties or to combine many loans on a single property. Typically, a blanket loan contains a clause known as a partial release clause. This provision allows the borrower to obtain the release of a single lot or parcel from the blanket lien by repaying a certain amount of the debt. For each parcel sold, the development lender releases a portion of the mortgage lien on the entire property debt. For each parcel sold, the development lender releases a portion of the mortgage lien and the entire property. The lender's release paperwork will stipulate the lien will continue to cover all other unreleased parcels. Thus, the lender retains a security interest in the unsold property for the remaining balance of the construction loan, but each purchaser of an upgraded or unimproved lot is able to acquire secure financings on the parcel. Okay, an open-ended loan. Another question on the state exam. Offers a security interest when the borrower executes a note to the lender, as well as any future advances of monies made by the lender to the borrower. The interest rate on the first amount borrowed is fixed, but future advances may incur interest at the prevailing market rate. An open-end loan is frequently a less expensive alternative to a loan for a home improvement. After the debt has decreased by payment over time, it permits the borrower to increase the debt to the original amount of maximum amount stated in the note. The note will contain the terms and conditions under which the loan may be open, as well as payback provisions. Now, what is a construction loan? It's finance the building of real estate upgrades such as homes, apartments, and offices. The lender guarantees the entire loan amount, but disperses the funds in installments during the construction. This is common for an FHA 203K. Okay, and that's what I'm doing now. I'm doing a 203K. These are also referred to as draws for the portion of the construction work done since the previous payments are provided to the general contractor or the owner. Before each payment, the lender conducts an inspection. The general contractor must deliver to the lender releases the relinquished all mechanic lien rights for the work covered by the payments. So you're paid in portions. Usually you're not paid up front. You have to do maybe 50% of the work before you even get paid. So it's a loan, a construction loan, not for all contractors. Typically, construction loans are short-term or interim funding. That's right. They give you a timeline that you have to start to finish. The borrower only pays interest on funds that have been dispersed. The borrower is anticipated to get a permanent loan, also known as an end loan or takeout loan, which take out the construction financing lender upon completion of the project by paying off the construction loan's principal balance. Sales and leaseback deals are not loans, but are utilized to finance major commercial or industrial buildings. The property and building where are typically used for business reasons by the seller are sold to an investor. The investor then leases the property back to the seller, who continues to conduct business there as a tenant. The purchaser becomes the landlord while the seller becomes the tenant. This enables a company to free up capital connected to real estate for uses of working capital. So if you see a question on the state exam, it will mostly ask you, the investor leases the property back to the seller. Okay. A buy down is a method of temporarily or permanently reducing the interest rate on a mortgage or trust deed loan. Perhaps a home builder intends to increase sales by providing below market interest rates. Or first-time home buyers may have difficulty qualifying for a mortgage at a current interest rate. The buyer, relatives, or the sellers may wish to assist in the qualification. At closing, a lump sum payment is always paid in cash to the lender. During the first few years of the mortgage, the payment reduces the interest rate and monthly payments by offsetting them. Typical buy-down arrangements cut the interest rate by 1 to 2% points during the initial 1 to 2 years of the loan term. The rate then increases. The expectation is the borrower's salary will improve, making it more probable that he or she will be able to afford a higher monthly payments. In a perpetual buy-down, a greater initial payment reduces the effective interest rate during the life of the loan. What is a home equity loan? A home equity loan is a kind of financing that capitalizes on the equity accumulated in a home. The initial mortgage loan stays in place. The second lien is the home equity. Although the home equity loan carries a higher interest rate than a purchase loan, it is an alternative to refinancing because the higher rate applies only to the amount borrowed. Additionally, the interest paid on the home equity loan up to $100,000 is taxable. A loan equity loan can be used to fund the purchase of an expensive item, such as a boat, consolidate current installment loans or credit card debt, and pay for medical, educational, home remodeling, and other expenses. You might see a question on the state exam on a home equity loan and a home equity line of credit, known as a HELOC. The lender grants the borrower an open-ended line of credit. The whole amount of the line of credit will appear on the borrower's credit record, even if it's not being used. On this plus side, the home equity loan can lead to a new first mortgage loan in the future. At some point, the homeowner might refinance all existing mortgage loans into a single loan with an attractive interest rate, in which case the original mortgage loan and the home equity loan would be repaid. The choice to borrow against a home's equity should not be taken carelessly. Investing the funds in home upgrades should increase the property's value, so creating more equity to replace some of the debt. The promise of paying off those other debts, especially credit cards and auto loans, may be appealing, but these obligations are unlikely to result in the loss of one's home. And once we get into there's the investors chapter. We'll learn more a little bit about HELOCs. So there's also laws that go into effect, especially in mortgage lending, okay? There has been a lot of fraud in the past, so these laws have been put into effect, okay? So one of them, which is very important, is the Truth in Lending Act, and we call this TILA. And let me tell you, you will be tested on this. It says there's another one, it's called the Equal Credit Opportunity Act, and we'll see what they are. And it's called ECOA, Community Reinvestment Act of 1977, CRA, and Real Estate Settlement Procedures Act are all the federal laws that govern mortgage lenders' lending practices. RESPA. Recent legislation designed to help property owners during the economic downturn is also discussed. So this is really important. Regulation Z and the Truth in Lending Act. Please pay attention. I know there's a lot we've been reading. The Federal Reserve Borders Regulations D, enacted to enforce the Title in Lending Act, TILA, requires credit institutions to inform borrowers of true cost obtaining credit. Okay, requires Truth in Lending, Regulations D, an act to enforce Truth in Lending. Credit institutions to inform borrowers of true cost of obtaining credit. Borrowers can compare the cost of various lenders with proper disclosures to avoid making uninformed credit decisions. Regulations D generally applies when a credit transaction is secured by a residence, regardless of the amount. The Regulation Z does not apply to any amount of business or commercial loans or agricultural loans. Before completing a transaction, a customer must be fully informed of all finance charges and the true cost of the financial under TILA. So the financial charges and true cost of any loan fees, finder fees, service charges, and points, as well as interest, must be disclosed in the financial charge disclosure. So we call it a CD. In the case of mortgage loan used to finance the purchase of a home, the lender must compute and disclose the annual percentage rate. And this is what we talked about, right? We had 3%, but on the CD disclosure, I'll have, you know, a different number. It could have a higher number, maybe a 4.678. That includes loan origination fees, points, and other charges, in addition to loan nominal interest rate, okay? So it has to be disclosed because of TILA, Truth in Lending. All these fees, we haven't gotten to the closing chapter, but once you see the CD, you see all the fees associated with that loan, okay? And the government has done this to show the truth in lending because people were taken advantage of. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, the Dodd-Frank Act, established the Consumer Financial Protection Bureau to protect consumers by carrying out federal consumers' financial laws. The CFPB consolidates most federal consumer financial protection authority in one place, including enforcement of RESPA, ECOA, and Truth in Lending. Creditor. For the purpose of Regulations D, a creditor is defined as anyone who extends consumer credit more than 25 times per year or more than 5 times per year. If the transaction involved the use of dwellings as security by written agreement, the credit must be subject to finance charge or payable more than one from 4 installments. These are on creditor. Rescission, what does that mean? In most regulations, the consumer credit transaction, the borrower has 3 business days to rescind and cancel the transaction. By notifying the lender, this rescinding right does not apply to owner-occupied residential purchase money, first mortgage, or deed of trust loans. So the rescission, right? If you're originating the loan before you get to the closing table, you can rescind that, but not at closing, not after you have closed your loan. You say, okay, no, I want to rescind the contract on a first mortgage. No. So you would only do that if you are refinancing that loan, okay? Only then you have a time period to rescind the contract. Advertising. This is big too. I took a whole CD course on advertising. Regulation C establishes strict guidelines. This is for mortgages, right? For lending. For real estate advertisements that refer to mortgage financing in terms in all media, including newspapers, flyers, signs, billboards, websites, radio or television ads, and direct mailings. General phrases such as flexible term available may be used, but the details must be provided in accordance with the act. So this is big because I've done advertising with loan officers to get buyers, to get clients. And one of the things that we always go through, oh yes, I have to send it to compliance because it has to be compliant with Regulation C. Most of the time, loan officers that work with realtors, right, they can pay up to 50% of the advertising. They can't pay more because it would be illegal, but they can help you with the marketing and advertising and pay 50% of it, okay? So now, why Regulation C? Because there's triggered words in advertising that can be misleading. Clickbait, right? Do this and you'll get that. So phrases like flexible terms available may be used, but details must be provided in accordance to the act. The details have to be part of the advertising. See, I just said it right now. Trigger terms are specific credit terms such as the down payment, monthly payment, finance charge amount, or loan term. These terms may not be advertised unless following information is included. So no trigger terms, right? So they have to include this. A down payment percentage or amount, an installment payment amount. Guys, Regulation D on advertising will be tested on the state exam. And a specific amount of finance charge, a specific number of payments, a specific repayment period. So you have to be open and honest about that advertising. A statement that there is no charge of credit. And any of these items appear in the advertising, the lender must disclose the down payment or percentage repayment terms, the APR. They have to disclose, okay? What is the APR? The down payment amount, the percentage and repayment terms, and whether the rate can be increased after consumption of the loan. So these things that appear in an advertising, the lender must disclose down payment amount, percentage, repayment terms, and APR. Penalties. I don't know if you ever taken out a credit card. I know it's not buying a house, but they have a whole note for you to look at, and they'll tell you the annual percentage rate on that credit card is, and they have all this information. If you have to pay an annual fee, they have to disclose that. Penalties. Other than certain advertising provisions, a creditor who fails to comply with TILA requirements may be held liable to the consumer for actual damages and costs of any legal action. So if we don't comply, someone can take legal action against us, as well as reasonable attorney fees. In other cases, a creditor may be held liable to a consumer for twice the amount of the finance charge, or up to $4,000 plus court costs, attorney fees, and any actual damages. Alternatively, a successful class action alleging that a creditor understand the APR and or finance charge could subject the creditor to punitive damages of 500,000 or 1% of the creditor's net worth plus attorney's fees and court costs. Furthermore, the willful violation is a misdemeanor punishable by $5,000 fine, 1 year in prison, or both. So I don't know, but just by reading that, my head hurts, right? We don't want to get in trouble with advertising. So especially mortgage companies, they have to do a lot of compliance before they put anything out there for the public. So now we look at the ECOA, what I said before, Equal Credit Opportunity Act. Okay, you will be tested on this, guys. The Federal Equal Opportunity Act prohibits lending discrimination based on a credit applicant. So if they look at the race, color, religion, national origin, gender, marital status, and age, and they discriminate, they can get into trouble. Or received a public assistance. According to ECOA, credit applications must be evaluated solely based on income, the stability of the source of income, net worth only, total assets and liabilities, and credit rating, not on these protected classes. ECOA's protections are both similar, race, color, religion, and national origin, and distinct from those provided by Fair Housing Act. ECOA includes age, marital status, and receipt of public assistance. Real estate professionals should be aware of the safeguards provided by this law because their clients should not face discrimination when applying for a loan to purchase or rent a property. Super important, guys. Okay. A creditor may not consider age unless the applicant is too young to legally sign a contract, which is usually 18 years or older. Through the creditor may consider age when determining whether income will decrease due to retirement. Lenders are not permitted to discriminate against recipients of government assistance programs such as food stamps or rent subsidies. Lenders may not inquire about a spouse unless the spouse is also applying for credit. So remember this and make a note, make an index card of this in case you see a question on the state exam. Lenders may not inquire about a spouse unless the spouse is applying for credit. They may not undervalue a woman's earnings or assume she will leave the workforce to raise children. If a loan application is denied, ECOA and the Federal Fair Credit Reporting Act require the lender to explain why in the statement must be provided to a loan applicant within 30 days under FCRA. The loan applicant also has the right to free copy of any credit report used in the loan application process. The agency in charge of enforcing ECOA is determined by the type of financial institution involved, the Fair Trade Commission, the Department of Justice, and other agencies enforced by ECOA. Okay, any questions so far? So I'm just telling you where you might see the questions on the state exam. Make sure you go over that. Community Reinvestment Act of 1977, CRA. Community reinvestment refers to financial institutions' obligation to help meet their community needs for low and moderate income housing. Financial institutions are expected to meet the deposit credit needs of their communities, participate and invest in local community development and rehabilitation projects, and participate in loan programs for housing, small businesses, and small farms under the Community Reinvestment Act of 1977, CRA, which was updated in 1995 and 2005. The law requires any federally related financial institution to prepare a statement that includes a definition of its community's geographic boundaries and identification of the types of community reinvestment credit offered, such as residential housing loans, housing rehabilitation loans, small business loans, commercial loans, and consumer loans, and public comments on the institution performance in meeting the needs of its community. The institution must post a public notice informing the public that their community reinvestment activities are being reviewed by the federal government, and they must make the results of those reviews public. Real Estate Settlement Procedures Act. Guys, you will be tested on the state exam on this, okay? RESPA, and go a little slower here, okay? Is a federal law that aims to standardize settlement practices and make sure buyers understand settlement costs. Buyers understand settlement costs. RESPA covers the purchase of 1 to 4 families. Remember, we said that there was residential homes that will be paid by federally related first mortgage loans. So it covers VA and FHA. Backed loans, other government-backed or assistance loans that are meant to be sold to Fannie Mae, Freddie Mac, Ginnie Mae, or other government-controlled secondary market institutions, and loans made by lenders who make more than $1 million in residential loans each year are all federally related loans. RESPA has rules about settlement and provisions that state that the lenders can't give kickbacks or unearned fees. So this 100% sure you will be tested. Fees to people who may have helped them get the business of the borrower. This could include, for example, a fee paid to a real estate agent for sending a borrower to a lender. So as an example, okay, referral fees. So you cannot have the buyer pay for referral fees, okay, if there was no service rendered. Just because someone referred you to someone else, the buyer cannot pay those fees. So think of it this way. For us realtors, we can get a referral fee because we are licensed to do so, okay? But if I have a client who referred me to their cousin, I'm not allowed to get any, that client of mine is not going to get any compensation because they're not licensed. So here, the lender does not give kickouts. My mind is going. Okay, I taught in the morning and now I'm teaching in the evening. So kickbacks or aren't earned fees. So if there was no service rendered, there's no referral fees that are going to be paid. So remember that, RESPA and kickbacks. All right, this could include, for example, a fee paid to a real estate agent for sending a borrower to the lender. The Consumer Financial Protection Bureau requires lenders to inform buyers about settlement costs by using 2 specific forms. A lender must give a loan estimate. So this, you're going to be talking to your client most often than none. I have 2 buyers that are going to the closing table in October. So right now we're talking about the loan estimate. It's early October for the end of September that we may close. So they're going to get some type of document saying how much is it going to cost you to purchase this house. And the closing CD is very similar, right? So the loan estimate could have some fees in there that could be taken out or added to the closing disclosure. So it's not too far away from what you're going to be paying at closing, okay? It says it's given within 3 business days of getting a loan application and let the buyer see the closing disclosure 3 days before the loan closes, right? That's the minimum that they can send it out. The 3 days, they have to maybe send it even prior to that. A lender must also give a buyer a copy, this is before the loan estimate, your home loan kit tool, a booklet with information about mortgage loans, closing costs such as settlement fees, title fees, recording and transfer fees, tax and insurance, escrow deposits, and other fees or charges add up to the total closing costs and how the closing process works. The closure forms are different for each type of loan. The cost list of the closing fee disclosure must match the ones listed on the loan estimate as closely as possible, and they usually do. So guys, this over here, this whole RESPA and here, and the loan estimate closing disclosure and the tool, your home loan toolkit, you will be tested on the state exam. All right.